Nirmal Bang, ladies and gentlemen. I'm Hital Daja. We have with us Mr. Hans Goetti, founder and CEO at HG Research, joining in. Welcome to the show, Hans, and always a pleasure to speak to you. In fact, wishing you and the viewers a happy Diwali and a happy New Year as well from all of us at Nirmal Bang.
The same to you. It's a big thing in India. Happy Diwali to all of you.
Thank you so much, Hans. Hans, my first question coming to you is, in fact, with regards to all the volatility that we're seeing in the markets across right now. What's your read?
Well, the read is that the fundamentals point into the direction of a recession. That's the case in the US, that's the case in Asia, and clearly the case in Europe. So the risk that we're facing now is a global recession. And at the same time, we have relatively high inflation, where the central banks are feeling compelled to raise interest rates, to tighten policy, they're going to QT. And in the meantime, the yield curve is inverted, so short-term yields are higher than long-term yields. And this is the environment that central banks are tightening into. So that creates a lot of volatility and a possible more downside risk from here.
So overall, last week as well, if you go to see in terms of global markets, specifically in terms of US, we did see some bit of an extension of the week's rally. European markets were also up, and there is a clear expectation probably that the Federal Reserve will slow its pace of rate hikes. What's your read of the situation?
Well, for now, I'm talking about the next meeting by the Fed. It's going to be 75 basis points. I mean, that's pretty much telegraphed. And it looks like it's just starting to sound like they would like to slow the pace of increases. So until a few days ago, another 75 basis point was sort of priced in for December. But that seems to look more like a 50 basis point increase right now. But the fact of the matter is that before you actually pivot and start lowering rates, which is pretty far into the future from now on still, you have to slow down the rate of increase and actually see what the effects are on the economy. Because what we're looking at here is a lagging effect. I mean, if the Fed has been tightening over the next few years, it's going to take another 9 to 12 months, if not longer, for it to show up in the real economy. And that is the risk that we're facing now, is that the Fed has actually overdone it and that's probably tightened a bit too fast, knowing, of course, that they should have tightened a lot earlier in 2020 and 2021. But now they seem to be wanting to do this within a matter of a few months. And that is risky in a way because, again, as I said, the risk of over-tightening is quite real here.
Right. And how do you see the ECB moving in terms of rate hikes?
Same thing. It looks like a 75 basis point increase this week, actually, and maybe a little bit of a rally in the euro. The euro is totally oversold. But again, in Europe, you have a deeper recession and you have higher inflation than in the US. On top of that, you have an energy crisis coming in winter, which is, by the way, self-inflicted, aggravated and amplified by the war in Ukraine. But that's not the only cause. There are other reasons for that. So Europe, in a way, is in worse shape than the US. And we'll see how that plays out. Again, it sort of increases the risk of a global recession where all the big economies are turning down at the same time.
Right. And overall, if we are seeing these kind of recessionary fears, especially with Europe, as well as if you talk about US as well, what is the kind of impact it could have with regards to emerging market economies like India?
You see, you have the US tightening aggressively, which puts upward pressure on the dollar. And that is not very good news for emerging markets. In fact, it's exactly the opposite of good news for emerging markets. As far as India is concerned in the emerging market space, it's probably one of the better positioned, if not the best positioned, because other emerging markets have huge dollar debt, and a stronger dollar obviously would make the debt servicing a lot more difficult. India is in a better position, and from a fundamental perspective, again, I'm talking about the 3 to 5 year perspective. India is probably the most attractive emerging market. But again, who has a 3 to 5 year view at this point? It's almost impossible. But what speaks for India is the highest growth rate of any economy in the world now. We have very favorable demographics, which you do not have in China. And you still have ongoing reforms. So I think all that speaks for India in the long run.
And Hans, specifically specifically, if you talk about the US as well, clearly everyone is right now laser focused with regards to the key earnings from the biggest technology companies that will be reporting earnings in the US, from Alphabet to Microsoft, Amazon, Apple. Now, clearly, these are going to be companies which are going to drive markets as well going forward right now. What's your anticipation? Because clearly, the analyst earning estimates have come down in recent months as companies have been facing foreign exchange headwinds and other growth concerns. Uh, how do you read this?
Well, first of all, earnings expectations have been downgraded to a degree where most companies that report are actually beating very downgraded earnings already. But you're absolutely right. We're going to see earnings downgrades, especially when you have a recession in 2023. More specifically, when it comes to technology companies, I expect them to beat, but you will see Apple, for instance, slowing sales, probably spreading up to other technology companies. I mean, their results will still be very good. And it remains to be seen whether where the guidance is. I think they will probably beat the out of the expectations that we have now. But the crucial thing will be where the guidance will be. And this is going to be a crucial week for, let's see, for the near term at least.
Right. And overall, with US as well on the, with the European markets on the political front, we have Rishi Sunak, who'll be replacing Liz Truss as the UK Prime Minister. How do you see the political angle on that front?
Well, I think this will give some stability. I think during the campaign, when Truss got elected as leader of the Conservatives, I think the debate there between Rishi Sunak and Truss was that he thought that her strategy to cut taxes and so on would lead to turmoil in financial markets. It was 100% spot on. So I would imagine that if he comes in now, probably keeps Jeremy Hunt as Chancellor, and it could hopefully give some stability to the pound, maybe the bond market in the UK, which is badly needed right now. I mean, I'm not per se against tax cuts, but you have to fund them. I mean, if the government decreases taxes, they should also cut spending. And that, of course, is not happening at this point in time. So I think Rishi Sunak could be a stabilizing factor along with Jeremy Hunt. So I'm relatively cautiously optimistic on that.
Right. And how are you seeing the political angle with regards to China and the economic data, which came out pretty delayed? Do you think that's something which could still provide some bit of instability in terms of China? And secondly, in terms of Japan's intervention in the currency market?
Well, first, China, I think there was a bit of hope, not expectation, but hope that maybe Xi will have a much more balanced standing committee and Politburo. But it seems now that he has really taken a political decision. These are loyalists. These are not pragmatists. These are ideologues. And I think that's what the market has been afraid of. It's almost a worst case scenario. And we see it in the performance of Chinese stocks listed in China and in Hong Kong. So there's a bit of a negative surprise there, if you will. So I'm not sure if this bodes well for China. I think for now, they have big problems. They have problems to deal with. The property market is clearly a problem. The slowdown in growth is a problem. We have seen it. Growth is quite slow. So here the fear is that there's not enough expertise and not enough pragmatism to deal with these issues. So again, it's more ideology over practicality. And when it comes to Japan, I mean, the only thing they could be doing would be to raise interest rates, get rid of the yield curve control, and the yen would increase. But that's not what they're willing to do, although they could, because inflation has now started to go up. So for some reason, they stick to their almost zero interest rate policy. And from time to time, they have to intervene in the currency markets. Now, interventions, they work in the near term, but it's not a long-term solution. But you have these, bouts of strength in the yen, and then it weakens again. So it would take a fundamental shift in monetary policy for the yen to strengthen.
Right. So overall, right now, from an India perspective, do you think India is one of the best placed from an investment perspective?
I would think so. I mean, if you're an emerging emerging markets as an investment theme is a bit of a different story. For that, you would need a clear signal that the Fed is willing not to cut rates, but at least to pause, to slow down rate increases, which would then maybe lead to more stable, maybe somewhat weaker dollar. And that, of course, will go a long way to help emerging markets. So as long as the dollar is going up and the Fed is tightening, I'm afraid that emerging markets are not exactly the place to be right now.
What are the
Well, I think at the moment it's more like capital preservation. I mean, if you look at what you get in a, it's maybe 4.5%, that's pretty good. I don't know many people who are able to achieve or down. So you get risk-free 4.5% when inverted yield curve. But I would think that if inflation comes down next year, and I think it will, not only because of Fed tightening, but also because the economy is slowing, you will have an emerging buying opportunity in longer dated bonds. I know it's a very contrarian view, but if you look at the 10-year bond, it's completely sold out, it's bombed out. And I think one should really start nibbling there. We should, I think, establishing position in 10 years. 10-year bonds will be rewarding on a 12-month basis in our view.
Right. So overall, very lastly, Hans, what would your bit of advice be to the investors?
Well, the advice is clearly you're in a, let's say, it's a risk-off mode. We currently have this rally in Wall Street, which, by the way, will probably extend a little bit further, but that is an opportunity to reduce position or reposition the portfolio into areas which have longer-term prospects. I mean, I'm thinking of cybersecurity. I'm thinking of aerospace and defense, which is clearly on the upswing given the geopolitical tensions everywhere. You may also want to look at biotech, some of the smaller companies, which could be takeover targets. So there are areas of opportunity. But in the meantime, I would think, why try to be the hero in the stock market when you get 4.5% risk-free in very short-dated bonds?
Absolutely. So I think probably that's something that one needs to consider as well from a bond market perspective, because absolutely the short-term ones, as you mentioned, are risk-free right now versus equity with the kind of volatility that we have been looking at. Thank you, Hans. Thank you so much for joining us on the show. It's always a pleasure to speak to you.
Same here.
Stay
Thanks for
safe
having
and
me.
speak to you soon again.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.